Why investing in emerging economies makes sense. Investing part of your portfolio in emerging economies makes sense for various reasons. Chances are your investments will outperform over the long term. Below I summarize the biggest benefits of investing in real estate in emerging economies. The focus in this post is comparing Indonesia and Poland to neighboring economies of Germany and Singapore respectively. As a frequent reader of my blog, you know that I prefer purchasing tangible assets over equities. In particular, I prefer to invest in real estate and finance my purchases exclusively with cash. I have done so successfully in Poland by timing the market. There, I saw an opportunity to get in 2015. I did so because it didn't make any financial sense to invest in Australia, USA, Singapore, or Germany. These four markets were the ones I was observing for years. Today even a 50% drop of my Polish investment won't hurt me much, as I have never counted on such massive capital gains and would still be in the black. Mostly I live of the 6.5% or net rental income, which is in complete alignment with my goals. Key reasons to invest in emerging markets. In a nutshell, the main reasons to invest in emerging economies are highlighted below. Economic growth outpaces advanced economies. Lower capital requirement to enter the market. Typically lower taxes on generated income. Higher salary growth. Higher capital growth. Diversification of risk in portfolio. Cheaper retirement option. Increased learning curve. Bigger bang for buck. 1. Economic growth outpaces advanced economies. Take a look at growth rates of emerging economies. You will find that they generally outpace advanced economies. These are opportunities for an investor to buy into a market below at a fair value. One of the best sources to compare countries is the OECD data website. As with all statistics that I haven't faked myself, I take these with a pinch of salt. Having said that, they work just fine for comparison and indicative purposes. Two leading indicators for me is the growth of the overall economy and the growth of disposable income. Growth of wages is also tightly related to price increases and spending power. The higher it is, the better from an investment perspective. Let's have a look at the growth of disposable income in Germany and Poland, for example. The data is directly taken from the OECD website. We can clearly see that Poland has outpaced Germany across most years. In 1995, Germany's GDP per capita was around $19,000 while Poland stood at $6,000. Germany's GDP per capita was more than 300% of Poland. Today Poland sits at an output of $30,000 while Germany only grew to $54,000. This equates to Germany's GDP per capita being now a mere 180% of Poland's. In a quarter century Poland has recently become a developed nation, the first amongst all new Eastern European Union member states. Few months ago, I wrote about Poland in my blog post titled The Art and Science of Investing in Poland. Let us have a look at another developing country I am getting more and more interested in. I'm watching Indonesia. Indonesia is a lovely country in Southeast Asia. Growth and inflation are generally high, currency fluctuations are volatile. From a property perspective, one can buy in relatively affordably. This means that for the same deposit amount in a developed country, you are able to buy for cash in Indonesia, omitting any bank loans. Let's have a look at Indonesia's historic growth rate. I pulled this chart from Trading Economics. This is a wonderful source of information. If we were to draw a trend line, you would notice that Indonesia's growth is actually accelerating over the long term and outpacing many of its neighbors, like developed Singapore. Because of the high growth, chances are on your side that your investment will pay off quicker and generate a better return. Indonesia has been growing like not many other countries for decades now. Comparing investing in Singapore versus Indonesia. Now, let's compare what an investment of say 150,000 Singapore dollars would be worth in Indonesia versus Singapore. We assume a GDP annual growth trend of 2% in Singapore versus 5% in Indonesia. I am always conservative in my calculations. That mere 3% difference would equate to a whopping $351,000 difference over 30 years compounded. Mind you, you could not even buy a shoebox in Singapore for $150,000 to start with. Chances of additional capital gains are high as inflation tends to be much higher in Indonesia than Singapore. Here's a table further illustrating the investment growth between these two countries. As a passionate scuba diver and management consultant, I have visited Indonesia for many years. I even lived there briefly in 2018. The growth is absolutely tremendous and one can notice the difference with each subsequent visit. Further, it has an amazing growth potential. There is still a long way to go to meet the Western level of development. In my opinion, Indonesia is a gold mine. But with higher returns comes higher risk. I wouldn't recommend starting to invest in such an exotic country if you are a novice investor. Prior investment experience, a good handle over the market and its ever-changing rules and regulations are a must-have. 2. Lower capital requirements to enter the emerging market. In Indonesia, the minimum capital requirement to purchase any real estate is $105,000 for foreigners. Foreign ownership regulations are rather limited but are improving. With a square meter price of around $3,000 in Jakarta, purchasing a small apartment is much easier than in Singapore. With an average price of around $13,000, it is slightly more expensive than Indonesia. Because of the lower capital requirements, the need for financing through a loan is also much lower. 3. Lower taxes in developing countries. When calculating the returns, one needs to understand all taxation requirements. There are typically taxes for the initial purchase of a property and annual taxes due for rental income and property tax. These tend to significantly vary across countries but in general are cheaper in developing countries. Over the span of an investment, it can make a huge difference in your return on investment, ROI. In Indonesia, the total rental income tax is around 30% whilst the property tax ranges between 0.1% to 0.5% of the annual value of the property. In comparison, Singapore rental income tax starts at 12% while property taxes hover around 0.3% for small apartments. At first glance, this seems favorable for Singapore until you understand that Singapore has a 20% tax for foreigners to buy. So buying $1 million property, you need to chuck out another $200,000 in additional stamp duty. You will likely need to finance the purchase, which would add a huge additional cost to your investment. Shaving off 30% rental income tax off your gross rental yield of 7.5% in Indonesia provides a higher bottom line than shaving off 12% off 2.5% in Singapore. So just for the cost of the foreigner tax to buy a small one-bedroom condo in Singapore, you could buy 1-2 more apartments in Indonesia and start generating a net positive income flow. Reinvested, it would make for a far superior ROI and one hell of a compounded wealth over decades. In the end, it is cheaper to buy outright in Indonesia even while paying higher ongoing taxes. 4. Higher salary growth. Indonesia has consistently ranked highly for salary growth globally. The growth rate has been around 10% between 2008 to 2016. This is a good indicator for a growing and developing market, especially when real wage growth has been declining significantly in the Western world. Chances for capital growth are much higher if people are earning more. House prices have been stagnant in Indonesia for a few years. With continuing growth of salaries, home prices will eventually increase to close the widening gap. 5. Higher capital growth. Capital growth beyond inflation is not required if you have a net positive investment. Of course, it is nicely seen. The rent-to-price ratio in Jakarta is one of the best across Asia. I tend to frequent the Global Property Guide for some excellent information. The graph below is from their website. Chances, however, are that over the long term the capital growth in a developing economy will outpace the capital growth of a developed country. This is mainly due to the wage and GDP growth discussed earlier. Looking at the 10-year capital gains, Indonesia looks pretty good. However, the real increase, net inflation, has been closer to zero. 6. Diversification of risk in portfolio. Most of my portfolio consists of rental property in Poland. At the moment I'm highly exposed to the Polish market. In order to diversify I am eyeing opportunities in Australia and other markets next. The main reason for this is diversification. Growing and de-risking my portfolio is top of mind for me lately. I don't like investing in equities and prefer tangible assets risk-free of hyperinflation. There is a huge risk in holding cash in a bank these days and an even greater risk of being invested in the stock market at present. Valuations are at all-time highs, bubbles surface everywhere, and I expect a global recession in the coming 18 months. The EU, China and the US have a huge impact on the global economy. All are showing signs of weakening demand, revising mediocre growth rates and exposing themselves to inflationary pressures. Meanwhile, central banks all around the world are keeping interest rates at historic record lows. 7. Cheaper retirement option. One of the most important criteria for me when investing in real estate is the potential of retiring in one of these countries later. I actively plan to spend a majority of my next decades in one of the countries I am investing in. Quality of life, healthcare, and associated costs are important factors I look at already despite having a fair bit to go being 37. If I decided to live in Poland, I could easily support a family and myself indefinitely from my current investments. I could even still save about 50 to 60% of my income to continually reinvest and grow my passive income stream. Instead I plan to go back to work for a few more years to increase my asset base, diversify my risk exposure, and grow my passive income streams. I want to be able to thrive and take care of my planned family anywhere in the world, including more expensive places such as Singapore. Investing in several countries will give me the option to choose later on where I want to live. More importantly, I could be traveling with the sun and enjoy endless summers. I really hate the cold. 8. Increased learning curve. One of the best things about investing in developing economies is the opportunity to learn, adapt, and thrive. Your learning curve is greatly increased by investing across borders. Beside the financial diversification, you can enjoy the travel and pick up a new language, understand a different taxation system, learn about another legal framework, make new friends, and immerse yourself in new cultures. There is so much to learn out there. Striving towards being a global citizen not only provides massive opportunity to self-develop, it is also great fun. 9. Bigger bang for buck. There are many good reasons to invest at least part of your capital in emerging markets. If you are a calculated risk-taker, like I am, you might choose to invest most of your capital there. The first million is the hardest, but you can absolutely get there. Ultimately, the return is what matters with investments. I prefer to have a lower but safe and steady return. Comparing gross rental yields globally, we can quickly gauge gross rental yields across some selected countries. You can make twice or thrice the net return compared to investing in a developed nation. And this is before maintenance costs and property taxes. In Australia, for example, property taxes and maintenance fees can easily eat up several months of your gross rental income before you start making any money. Before you know it, your investment property makes less than a savings account. I have compared renting versus owning in another blog post, if you want some details on the fee structures. If you are on your path to financial independence, you can greatly accelerate your financial independence by investing in developing countries. Assess if it makes sense for you. In my case, Poland was a perfect choice since I have family ties to that place. Maybe you have other opportunities that make sense. In any case, consider the option of investing abroad versus at home if you live in a developed economy. Lastly, if you are interested to learn more, I have recently published my first ebook on how to purchase your first investment property. It is focused on the criteria I use to assess city rental units, and you can get access to it by subscribing to my newsletter in the form below. For freedom and to live your dreams. Your financial gladiator.